The wealthy barber was definitely 100-0, but I actually think the pendulum's gone too far that way with the over 45 crowd.
So when I initially read, like going back 20 years ago when I started reading finance books and investing books, the position was always that you should have, 70-30, 70% stocks, 30% fixed income. And if you were more aggressive, maybe 80% stocks, 20% fixed income. Now it seems like the people I talk to are 100. You should be, if you're young and you don't need that money and you're willing to let it sit, you should be 100% equities. So that's been a hard thing for me to reconcile in, I don't know, just in how I think about it.
It's interesting because I think I kind of led the charge accidentally all those years ago, 35, 36 years ago on the 100-0 for younger people. And the wealthy barber was definitely 100-0. But I actually think the pendulum's gone too far that way with the over 45 crowd. And I now see a lot of people, including people in my friends group, who have, 80 and 90 and 100% of their wealth at age 65 and 70 in equities, and frankly have done very well following that split at this point. But markets are expensive right now by any historical benchmarks. And we could have a prolonged period of challenging returns or subdued returns. And I hope that they're factoring that in to their forecasts and their planning, working along with their advisor. But going back to your premise, I think a lot of people have maybe gone too far at a later age on that front. Every situation's different, but that worries me a bit. I do believe for a lot of the younger investors, people like my kids, in their early 30s, I have no problem with them having the vast majority of their long term money, money that they're setting aside for retirement in equities.